Hey everyone, my name is Alex Morgan, and today we're diving into one of the most controversial and explosive topics in the entire commodities market right now, the silver price. More specifically, the growing argument that the silver price you see on your screen every day may not reflect the real underlying stress in the physical market. Because while paper silver contracts have been swinging wildly, even printing extreme spikes toward the $70 plus region in thin liquidity moments, reports from dealers, vault flows, lease rates, and wholesale premiums are telling a completely different story. Physical supply is tightening, lease rates have surged, inventories are shifting, and the disconnect between paper and physical may be reaching a breaking point. If you want macro-driven, data-focused analysis on gold and silver without the noise and without the conspiracy hype, make sure you subscribe right now. We're going to break this down logically, step by step, and by the end of this video, you'll understand what could actually happen next in the silver market and where prices may be heading. Let's start with the core issue, what people mean when they say the silver price is a lie. What they're usually referring to is the difference between the paper price, the futures price traded on exchanges, and the cost and availability of physical silver in the real world. The benchmark global silver price is largely discovered on the futures market, particularly on the COMEX, which is operated by the CME Group. These contracts allow traders to buy or sell silver for future delivery, and the vast majority of them are settled in cash, not metal. That means price discovery is heavily influenced by leveraged financial positioning rather than immediate physical demand. Now here's where things get interesting. In recent months, silver lease rates, the cost to borrow physical silver, have spiked significantly. When lease rates rise, it usually indicates stress in physical availability. Bullion banks borrow silver to make delivery, to hedge, or to meet obligations. If borrowing costs rise sharply, it suggests that physical metal is harder to source. Historically, spikes in lease rates have often preceded major price volatility. At the same time, we've seen fluctuations in registered silver inventories inside COMEX vaults. Registered silver is the metal available for delivery against futures contracts. When registered inventories decline while open interest remains elevated, it increases the potential for delivery stress. Even if an outright shortage never materializes, the perception of tightness can trigger rapid repricing. Now let's address the $72 print. Occasionally, in low liquidity conditions, thin trading windows, or algorithmic misfires, we can see extreme price spikes in futures contracts. These do not always represent sustained market levels. However, they expose fragility. When volatility explodes upward that quickly, it tells you the market structure is thin. It tells you positioning is crowded. It tells you there is sensitivity to order flow imbalance. So is the silver price a lie? Not exactly. It's more accurate to say the paper price reflects leveraged financial positioning more than immediate physical scarcity. But when physical tightness increases, eventually that stress bleeds into the futures market. Let's bring in industrial demand. Silver is not just a monetary metal like gold. It is heavily used in electronics, solar panels, medical applications, semiconductors, and electric vehicles. The global push toward renewable energy has significantly increased silver demand for photovoltaic cells. Solar panel installations continue expanding in Asia, Europe, and North America. Even conservative projections show sustained structural demand growth over the coming decade. On the supply side, primary silver mines are limited. Most silver is produced as a byproduct of mining for other metals like copper, lead, and zinc. That means silver supply growth is dependent on broader base metal production. If global growth slows and base metal mining decreases, silver supply can tighten further. Several industry reports over the past 2 years have pointed toward recurring silver supply deficits, meaning total demand has exceeded mine supply plus recycling. These deficits are often filled by drawing down inventories. But inventories are not infinite. Persistent deficits eventually matter. Now combine this with investment demand. When macro uncertainty rises, inflation, geopolitical tensions, banking stress, investors turn to precious metals. Gold typically moves first. Silver follows with higher beta. If gold is strong and inflation expectations rise while real yields fall, silver often accelerates more aggressively. Let's connect this to monetary policy. The Federal Reserve's interest rate path plays a critical role. When real yields rise, silver struggles. When real yields fall, silver thrives. If upcoming inflation data cools and markets anticipate rate cuts, silver could surge alongside gold. If inflation reaccelerates and yields spike, silver may face short-term pressure. But here's the key difference between gold and silver. Gold is primarily a monetary asset held by central banks, silver is more sensitive to industrial cycles. If global growth stabilizes while monetary policy eases, silver could outperform gold dramatically. If growth collapses into recession while rates remain high, silver could initially underperform. Another metric worth watching is the gold-to-silver ratio. Historically, when this ratio reaches elevated levels, silver tends to outperform in subsequent periods. When the ratio compresses sharply, silver rallies faster than gold. If gold remains structurally supported by central bank buying and macro instability, silver has the potential to catch up in an explosive fashion. Now let's talk about ETFs. Silver-backed ETFs hold large quantities of physical metal. When ETF inflows increase, physical metal is absorbed from the market. When investors redeem shares, metal flows back into circulation. Monitoring ETF holdings provides insight into investment demand trends. Futures positioning data also reveals whether hedge funds are heavily long or short. Extreme positioning often precedes reversals. If speculative shorts become crowded while physical tightness increases, short covering rallies can be violent. So what could happen next? Scenario 1. Physical tightness intensifies. Lease rates remain elevated. Inventories decline further. Inflation cools slightly and real yields fall. In this environment, silver could break upward decisively, potentially challenging and exceeding prior highs. Volatility would likely expand, and price discovery could accelerate rapidly. Scenario 2. Economic data weakens sharply, triggering recession fears. Industrial demand expectations fall. Even if monetary policy turns dovish, silver could initially drop alongside risk assets before stabilizing. In this case, gold may outperform silver temporarily. Scenario 3. Inflation surprises higher and central banks remain restrictive. Real yields rise. The dollar strengthens. Paper markets push silver lower even as physical premiums remain firm. This would deepen the disconnect narrative and potentially set up a later explosive rebound once policy shifts. Longer term, structural forces support silver. The energy transition requires silver. Electronics require silver. Emerging markets continue urbanizing. Meanwhile, supply growth remains constrained. If monetary policy becomes more accommodative over the next 12 to 24 months, investment demand could layer on top of industrial demand, creating a powerful bull cycle. However, silver is volatile. It can move 5 to 10% in days. Investors must understand that leverage amplifies both upside and downside. Risk management is critical. Let's address the psychological factor. Retail investors often interpret physical shortages at coin shops as evidence of imminent price explosion. But retail supply bottlenecks don't always reflect wholesale market conditions. Fabrication bottlenecks, mint capacity limits, and distribution delays can create local shortages even when wholesale bars remain available. Still, when wholesale tightness aligns with rising lease rates and declining inventories, that's when market structure becomes fragile. Watch these indicators closely. Lease rates, COMEX registered inventories, ETF flows, gold-to-silver ratio, real yields, and dollar strength. These are leading signals. If silver sustains momentum above key technical resistance, algorithmic funds could pile in, driving rapid upside. If it fails at resistance and macro conditions tighten, corrections could be sharp but potentially temporary. The idea that the silver price is a lie oversimplifies a complex system. It's more accurate to say the futures market dominates price discovery until physical stress forces repricing. When that repricing comes, it often happens fast. The next phase in silver likely depends on monetary policy direction and global growth stability. If we see synchronized easing and steady industrial demand, silver could enter a powerful multi-month rally. If liquidity remains tight and growth deteriorates, volatility will increase but direction may be less predictable. In conclusion, the silver market stands at a structural crossroads. Physical tightness signals are flashing. Paper markets remain leveraged. Macro forces are shifting. Whether silver explodes upward or experiences further turbulence will depend on the interaction between monetary policy, industrial demand, and investor positioning. If you want continued updates as this unfolds, make sure you subscribe right now. We're tracking the real data, the real macro drivers, and the real positioning shifts, not the hype. Because in markets like silver, preparation beats reaction every time. I'm Alex Morgan. Stay sharp, stay informed, and I'll see you in the next video.